In 1929, you would have been one of the richest men in America. You would have predicted the biggest crash in stock market history and made $100 million from it in a single month. 5 years later, you would have been completely broke. This isn't a story about a bad investment, it's a story about what happens when you get so good at something that it stops being able to save you. His name was Jesse Livermore, and by the time he was 40, you would have called him a genius. He started as a teenager, copying down stock prices on a chalkboard in Boston, and by his 20s he had taught himself to read the market better than almost anyone alive. He didn't trade on tips, he didn't trade on rumors, he traded on patterns, on timing, on a feel for when a stock was about to turn that took him years to build. When the market crashed in 1907, he shorted it and made $3 million in a single day. When it crashed again in 1929, he shorted it again and walked away with $100 million, which today would be worth more than $1 billion. He had done the one thing every investor dreams of doing. He had timed the market perfectly, not once, but twice. Here's where your brain expects the story to end. The genius wins, the genius keeps winning, the genius dies rich. But that's not what happened. By 1934, Livermore was bankrupt. Not poor in the relative sense, not had to sell the yacht poor. Actually legally completely bankrupt. The man who outtraded the entire stock market lost every single dollar of it within 5 years. And if you ask most people why, they'll tell you he got unlucky, or the market turned on him, or he made one bad trade too many. None of that is true. He lost it for the exact same reason he made it, and once you understand why, you'll never look at good timing the same way again. Let's get something out of the way first, because it's the part nobody explains properly. What does it actually mean to time the market? It means trying to buy right before prices go up and sell right before they go down. That's it. It sounds simple, almost obvious, like something you just need good judgment and a bit of nerve to pull off. Livermore had both in abundance. He read newspapers, tracked railroad shipments, studied cotton harvests, and built what was essentially a mental spreadsheet of the entire American economy decades before spreadsheets existed. He wasn't gambling, he was, by every reasonable definition, doing market timing the right way. So here's the question worth sitting with. If the smartest, most disciplined market timer in history couldn't sustain his success, what does that tell you about the skill itself? In 2024, a research firm called DALBAR published a study that, on the surface, has nothing to do with Jesse Livermore. They looked at how the average investor actually performed compared to the stock market itself. The S&P 500 returned just over 25% that year. The average investor, the real human being putting real money into real funds, earned about 16.5%. That's an 8.5 percentage point gap in a single year, in a year where the market was going up, not down, up. The investors weren't losing money to a crash, they were losing money to themselves. DALBAR has been measuring this every single year since 1985, and the pattern never changes. Over the last 20 years, the S&P 500 has returned roughly 10% a year. The average investor has earned closer to 9%. That 1 percentage point sounds small until you compound it. On a $1 million portfolio over 20 years, that gap is worth over $1 million in lost growth. The market didn't take that money from anyone. People gave it away, one well-timed decision at a time. This is what researchers call the behavior gap, and it isn't caused by bad investments, it's caused by good timing. Specifically, it's caused by investors pulling money out right before the market recovers and putting money back in right after it's already gone up. They sell at the bottom because it feels smart. They buy back in at the top because it feels safe. Every single decision feels in the moment like reading the market correctly. That's the part that should unsettle you. The behavior gap isn't a story about stupid investors, it's a story about smart ones acting on feelings that are dressed up to look exactly like timing. Now go back to Livermore. He wasn't an amateur falling for an obvious trap, he was a professional who had built an entire career proving that timing was possible. And that's exactly what made him vulnerable to it in a way an amateur never could be. Once you've timed the market correctly twice, at a scale most people can't even imagine, your brain stops treating the next decision as a guess. It starts treating it as a skill you've already proven you have. Psychologists have a name for this. It's called overconfidence bias, and it gets worse. Not better. The more times you've been right in the past. Livermore wasn't reckless because he didn't understand risk. He was reckless because his own success had quietly convinced him that the rules applied to other people now. There's a deeper mechanism running underneath all of this, and it comes from two researchers named Daniel Kahneman and Amos Tversky, who spent decades studying how humans actually make decisions involving risk and money. In the late 1970s, they discovered something that completely upended how economists thought about investing. They found that losing money hurts roughly twice as much, psychologically, as gaining the same amount of money feels good. They called this loss aversion, and it explains something strange about traders like Livermore. It's not that he was afraid to lose, it's that once he was already losing, the pain of locking in that loss became unbearable, so he held on, doubled down, and waited for the market to prove him right instead of accepting that this time it wouldn't. This is the twist that most retellings of his story leave out. Livermore didn't lose his fortune because he panicked. He lost it because he didn't. He held positions that were bleeding money because admitting the loss felt worse than the loss itself. The same discipline that let him sit patiently through years of research, waiting for the perfect short, became the exact thing that kept him glued to a sinking position long after a smarter, less experienced trader would have walked away. Think about what that means. The skill that built his fortune and the flaw that destroyed it weren't two different things. They were the same trait, pointed in different directions. Patience that waits for the right moment is genius. Patience that refuses to admit the moment has passed is ruin. From the inside, in the middle of the decision, they feel identical. This is where the story stops being about one trader from 100 years ago and starts being about anyone who has ever opened an investing app during a bad week. You don't need $100 million to fall into this pattern. You need exactly one thing, a moment where the market drops, your stomach tightens, and a small, very convincing voice tells you that pulling out now is the smart move, the disciplined move, the move a careful person makes. That voice doesn't sound like panic. It sounds exactly like judgment. That's what makes it so dangerous. The DALBAR data doesn't show investors making obviously stupid decisions. It shows millions of people making decisions that felt, in the moment, exactly as reasonable as Livermore's did. There's an old, often repeated claim in the investing world that Fidelity once looked into which of its customer accounts performed best over a long stretch of time, and reportedly found that the top performers were accounts belonging to people who had forgotten they even owned them, or in some cases, people who had died. Whether or not every detail of that story is precisely accurate, the underlying lesson behind it is one that shows up in study after study. The accounts that did nothing beat the accounts that did something. Not because doing nothing is a strategy, because doing nothing removes the one variable that consistently destroys returns, a living, anxious human being making decisions in real time. That should reframe something for you. The goal was never to find a way to perfectly time your buys and sells. The goal was to design your financial life so that timing matters as little as possible. Every dollar you put into an automatic, recurring investment instead of a single, carefully timed lump sum is a dollar you've protected from your own future panic. Every long-term account you genuinely forget about for years is, statistically, more likely to outperform the one you check every morning. This isn't a metaphor, it's what the data has shown for 40 straight years. And here's the part that connects all the way back to the beginning. Livermore eventually understood this himself decades too late to save his fortune. In his later writings, he admitted that his biggest losses never came from a lack of market knowledge. They came from ignoring his own rules in moments when his emotions convinced him this time was different. He knew on paper exactly what discipline required. Knowing it and feeling it in the moment a position is bleeding red are two completely different experiences, and only one of them is available to you when your money is actually on the line. So think again about that question from the start. If the man who outtraded the entire stock market twice, at a scale almost no one has matched since, couldn't sustain it, what does that tell you about your own attempts to time things perfectly? It tells you the skill you're chasing might not be the one that determines your outcome. The investors who quietly built wealth over the last 20 years weren't the ones who guessed correctly more often than Jesse Livermore. They were the ones who built a system that didn't require guessing at all. You opened this video expecting a story about a brilliant trader who lost everything. What you actually got was a mirror. Every time you felt that urge to check your portfolio during a rough week, to make one small adjustment because it felt like the responsible thing to do, you were standing exactly where Livermore stood, holding the same conviction he held right before it cost him everything. The market didn't beat him, his own certainty did, and the only real difference between his story and yours is how many zeros are attached to the lesson.